there are a number of portfolios, and the one portfolios we're going to look into are the heuristic portfolios, which are not formally defined, but they are some sort of simple portfolios that we're going to use. And there are certain examples of these simple portfolios. One is the buy and hold, and we buy a stock and then we hold it. The other is buy and rebalance. So we buy a stock, but at certain frequencies, we rebalance the stock or the weight of the stock. An equal weighted portfolio, or 1 divided by n portfolio, is a simple portfolio when, if you have an n asset, you allocate 1 divided by n to each of them without considering their expected return or expected covariance. So it's just independent of these parameters. It's always 1 divided by n. Quintile portfolio, so we, according to some signal, we sort the stock and make quintiles out of them. And we long the topmost quintile and short the bottom quintile according to the signal. So this is known as quintile portfolio. And these doesn't return. So here, these 4 of them doesn't depend on expected mean. And global maximum return portfolio, this depends only on mean, doesn't depend on covariance. And again, these are the heuristic portfolios, so they are less complicated than the portfolios that we use in the practice. So if you look into the buy and hold strategy, this is one of the simplest investment strategies because it just selects one asset and allocate the whole budget that we have to the asset. So buy and hold and buy and rebalance are basically similar portfolios. So they are basically select just one asset. But in buy and rebalance, so we choose one asset, but we reevaluate the choice of the asset regularly. So for instance, we choose an asset, we observe the asset in a month period, then after a month, we basically, if we think that the asset didn't perform that well, or if we have another asset that we think will perform better, we replace the portfolio with the new asset, or we keep the portfolio. So in buy and hold, we choose one asset and stick to this asset forever. So we buy an asset and we hold it, and we get the return from just one asset. And the belief behind such investment is that asset will increase gradually in the value over the investment period. So we try to basically select an asset that will give us the highest return. And in this case, the one thing we are using the variance or selecting a portfolio instead of single asset is diversification. So diversification means that by using the multiple assets, we are decreasing the variance, decreasing the risk. So diversification means we decrease variance, but in this case, there is no diversification. In buy and hold case, decrease variance or portfolio by selecting mixture of assets. So depending on the covariance relationship or the correlation relationship between the assets, we are getting a diversification if we use the variance in stock selection. But here for these simple ones, we don't use the variance of this portfolio. That's why there is no diversification. And again, here there are a bunch of methods to select the assets. One is a technical analysis. So in technical analysis, you look at the price of the stock over time, such as like this. And if it goes too high, if you detect that it goes too high, again, there are certain things we'll see. And this is known as the technical analysis. Traders use this a lot. So if you think that the asset goes too high, then you think that it's overvalued, and then you start to sell the asset or short sell the asset. But if you think that the asset price goes too low, then you think that the asset is undervalued. So it means that the price is undervalued, so it's not reflecting the correct price. And once you detect an asset is undervalued, then you buy the asset, assuming that it will revert back to its original or the correct price. And mathematically, this is just an E. W weights are just an E, where E is for the ith one, it's 1, otherwise it's 0. So it's a portfolio of a bunch of zeros and just one at an ith location. So this is buy and hold and buy and rebalance strategies. So in this case, we have, here's an example. So this is buy and hold strategy for different asset classes. for different periods, starting from the beginning of the 2013 and end of 2016. And here is basically the wealth curves. So here we assume that we start with $1. So this is just to make things easier. So we start with $1. And depending on how basically the market perform, this is how the performance of the stocks change. And if we have done this, so if you have a single buy and hold strategy, buy the asset at the beginning of 2013, and then keep it end of the 2016, then basically the Apple will give us the highest return. So we'll have almost like a more than 400. So it will be more than 400. No, it will be like approximately 300, 400 return. And the rest of them will be give us like almost like 100 return. And some of the stocks, like for instance, stock A, so these are the tickers of these stocks, will lose its value, so that will, if we invest in $1, we'll get something like maybe 0. I'm just making it up, $0.2. So for comparison of the performance, such simulations are applied, and the wealth curves, so these are called wealth curves. So it shows basically if we start with some amount, how much our wealth become over time for the strategy. In this case, strategy is quite simple, and this wealth curve shows the performance over time. And another portfolio is equal weighted portfolio, or 1 divided by n portfolio. So again, the goal of this quantitative portfolio management is diversification. So the reason that we are not investing all our money into one stock, but investing our money into different stocks and kind of balancing them, is the quantitative portfolio management. And this is what the diversification is all about. And that's what we are trying to achieve. And one simple way to achieve diversification is basically allocate our capital equally into all assets. So in this case, we assume that we don't have any prior. So assume that if we have A, B, C, and D our stock, so we allocate 25% to all of these portfolios, or all of these asset classes in our portfolio. And in this case, we do not assume any prior. We do not know whether the A will return higher than B, or whether B will return higher than C. We don't have such information, but we assume that by allocating equally, we'll get some diversification. And the diversification, or the volatility we'll get, will be V times V vector times basically the covariance matrix times V. So this will give us a volatility V transpose, W transpose, give us a 1 times n vector, in which case everything will be 1 divided by 4. In this weight vector, we have the covariance matrix, historical covariance between the different assets we are interested in. And this is n times n. And in this W, we have n times 1. And the result is 1 times 1, just a value. And this resulting is a variance value, and which is related to diversification. Related to diversification. Related to diversification. And again, this is one of the simple rules. So, and again, this has been highly used. So in practice, it didn't perform, it performs quite normal. So it doesn't perform that badly. So that's why, so for instance, many of these kind of uses. So for instance, Standard & Poor's is an index. So you can see S&P 500 also is an index. But it's a market cap weighted index. So the weights of the stocks are market cap related. So S&P 500 is also a portfolio. So index is another portfolio, but it's market cap weighted. And in this case, the market cap is basically the number of stocks that a company has, number of stocks times the share price. Times share price. This is known as the market cap. So for instance, market cap of one of the largest companies is Apple, which is almost like a $2 trillion. So Apple's number of stocks times its share price is like a $2 trillion, and that's what its market cap is. So in S&P 500, it's market cap weighted. So that's why the companies with higher market cap are basically the ones get the higher weight, and the sum of the weights are 100. And again, since it's an index, there is no shorting. So the total is 100%, but everything is long only, and there is no shorting. And there are other indices as well, which we don't go over in this course, but they are equal weighted. So they are made up of different assets, and each asset is basically equal weighted contribution. And again, there are certain things about the empirical performance about these portfolios. So for instance, in this case, different portfolio performances, and in terms of the Sharpe ratios for the 1/n portfolios tend to perform quite well compared to the other portfolios in many domains, I will say. Again, another portfolio is quintile portfolio. So quintile portfolio is used a lot in practice as well. And there are two types of quintile portfolios: long-only quintile portfolios and long-short quintile portfolios. In long-only quintile portfolios, we only long the assets into the quintiles. And what we do here is we only use the longing for the subset of assets we selected. In long-short quintile portfolios, we both long some of the assets, and we also short some of the assets as well in the portfolio. And in this case, the idea is same for both of them. So we have n stocks in the universe. What we do here is, according to some criterion or some signal, so for instance, this can be profitability. So what we do here is we come up with a metric that calculates the profitability of the companies. Profitability, this is just an example. So we calculate the profitability for all the assets that we have, and then we want to invest in higher profitable companies. And we think that the higher the profitability, we have basically a thesis. We say that higher profitability is, higher it will return. So this is our the thesis. And depending on our thesis, we rank the n stocks that we have according to this criteria. So for instance, if the stock A has the higher profitability, then it's at the top of the stocks. And what we do here is we divide them into 5 parts. And the top part is longed in long-only quintile, in long-only quintile portfolios. And in long-short quintile portfolio, we basically long the top part and possibly short the bottom part. So for instance, if we have 20 assets, let's say A1 up to the A20, and we basically rank them according to the profitability criteria. Again, the profitability here is just an example. So A1 is first, assume that they are sorted, A2 becomes the second, and up to A20. So these are the assets. And here is A3 and A4. So we divide them into quintiles. So this is the first quintile, starting from A1 up to A4 quintile. And in this case, what we do here is we long only these top set of assets, and we are not interested in the remaining of them. In long-short quintile portfolios, we long the top one, A1, A2, A3, and A4. Their total weight will be 1, for instance, or the 100%. Again, these weights can be adjusted. And the bottom portfolios, which has the longest characteristics, A17, A18, A19, and A20. So for the bottom one, we short them. And again, we short them, and their weight can also be negative 100%. I'm just, again, making this up. The weights can be adjusted accordingly. And in this case, again, we can rank the stocks in different ways, and there are different rankings. So profitability is one of them. There are other rankings as well. One is by their expected return. So if we expect, or if the historical return of a portfolio is, of a stock is higher, then we can expect it to return higher in the future, or it may be the other way around as well. If the stock returned higher, then we can expect it to return lower as well. Then the signal will change the sign. And another will be, instead of just the expected return, we divide it by the expected volatility as well. So expected variance, so covariance. So expected return in this case, divided by expected covariance, which is the risk of the stock. Expected return divided by expected covariance. And both of these expected return and expected covariance are made up of historical matrices. Historical expected covariance. And lastly, again, expected return, but it will be expected volatility, which will be another signal to rank these stocks at. And this is quintile portfolio. And lastly, one of the simplest one is global maximum return portfolio, which is known as GMRP. So in this case, basically, we have the expected return for different asset classes. And in this case, we want to invest only in the one with the highest return. So from that perspective, it's like buy and hold strategy. So it's very similar. But in this case, it's an optimization problem, which is convex and which can be solved optimally, but it's very trivial to solve. So we want to allocate the weights such that weights will be 1. Weights percentage will be 1 among n assets. And we want to maximize the weight times the expected return. So in this case, the simplest return will be allocate the weight to the highest return, will give us the optimal solution. Allocate weight to highest return. And in this case, this is a trivial solution. And that will give us the global maximum return portfolio solution. And we are allocating all the budget to the asset with the maximum return. And the problem here is that since the estimated return are estimated from the historical ones, this is quite noisy, and that can be kind of problematic. So this is one of the problems. So estimation of the mean return can be noisy. And another problem here is that since we are investing in a single asset, then the portfolio is lacks of diversification. And again, because it may not perform quite well in the future, because an asset returned higher in the past doesn't mean that it will return higher in the future. So in this case, we are ignoring all the covariance relationship between different assets. So we are just focusing on the asset with the highest return in the history. And again, the past performance doesn't guarantee the future performance. That's why this will not be a good strategy. So, okay, here is for different asset classes, an example of dollar allocation for equal weighted portfolio, quintile portfolio, and global maximum return portfolio. So, okay, here is again the portfolio allocation of the stock heuristic portfolios among the assets starting with Apple, AMD, and includes the other one, including the CF. And the y-axis shows the dollar amounts invested. And again, for some of them, all the dollars are invested in single one, such as Apple, which has historically the highest performance. But for some of them, it's not this case.